There's a lot riding on the Fed's two-day meeting, writing the following. We think Powell will shift the narrative around QE and should clearly state that it's a tool to achieve the dual mandate via keeping rates low. Without that, long-end rates will rise a decent amount. Priya joins us now with more. Priya, build on that for us, the positioning for a steepener and the Fed's role in it.
Sure. Thanks for having me, John. So Treasury, U.S. Treasury is funding a pretty big deficit, and they have taken strong steps to increase the duration of what U.S. Treasury is issuing. So they're issuing a lot of 10-year, 20-year, 30-year. Meanwhile, the Fed is buying $80 billion a month, which is a lot, but they are buying it in a much shorter duration. So I think the fact that these auctions have gone okay, the fact that the long end is actually still stable, tells me that the market is pricing in some shift in language around QE. And I think it's the language around QE is stale, I would argue right now, because the Fed says it's for market functioning reasons. Market functioning is back to COVID levels and has been for a while. So our call is that the Fed is likely to make that narrative shift to say it's a tool to keep long end rates low. Now, as I think Mike was saying, they want flexibility, and I'm all for flexibility, but at least clarify the intent, clarify that you're willing to do what it takes. They need to buy more, they'll buy more. If they need to extend the weighted average maturity of their buying, they'll do it. I think we need to hear that from Chair Powell, because otherwise the long end is going to be extremely vulnerable, because we can all look ahead and project how much supply is coming. And if the Fed doesn't have your back, if you may, then those long end rates can be a lot higher at potentially the worst possible time where we're losing fiscal support as well.
So, Priya, what are you advising to clients at the moment on how they should position in the Treasury market?
I am long Treasuries here in our model portfolio. I'm actually telling investors that there's, if we're in a 50 to 75 basis point 10-year range, we are near the upper end of the range. And we've got some really massive risk events in the near term. We have the potential risk of a COVID spike. We're not seeing fiscal support. Now, let's see if this bill, this problem solver caucus bill goes through. But in a highly politically charged environment, if that doesn't go through, you're losing fiscal support. We have an election with a lot of process risk, as I call it, which is not knowing what the outcome might be on election night, plus the actual uncertainty around elections, which is very hard for any market to price because you've got binary outcomes. In that scenario, owning safe havens, long-end treasuries, and the 2 years no longer a safe haven, because the 2 year, the 5 years, all anchored. So therefore, you have to move out the curve. So I actually recommend that, in the near term, if you've got risk assets in your portfolio, owning some safe haven assets actually makes sense.
Priya, you mentioned that range on 10-year treasuries, the top end 90 basis points since April, the bottom end 50 basis points. Many people are trying to work out how we break out higher, how yields increase. Bank of America put out their fund manager survey for the month of September this morning, and I wonder if anything like this resonates with you. I'll put the graphic up on the screen for everybody to see, but it basically showed that 41% of investors think it would take a credible COVID-19 vaccine to trigger higher bond yields. The next step was 37% looking for inflation, and then it was high debt levels, and then it was the election outcome and higher oil prices and all of that. But where does COVID-19 and a vaccine rank for you, Priya, in what could unlock Treasury yields to a breakout to the upside?
Right. I would give, if I was participating, I would have picked the vaccine and COVID as well, just because for inflation, I'm actually not sure, as much as I appreciate everything the Fed is doing, I'm not sure that they have the tools to really let inflation rise. I think it'll only come from the fiscal side because it's a demand shock. It's all about COVID. Do we get a pickup as kids are back in school and economies are reopening? Do you get that pickup? But on the vaccine point, do we get an effective vaccine? Is it distributed? Does everyone take it? And then is there any structural damage? So when I get the question, why does the Fed need to do anything? Interest rates are low. Well, part of the reason is some of it is priced in, some easing. Part of it is, what if you do get a vaccine? Do we want, big tightening in financial conditions because rates rise and then it shortchanges the recovery? Or can the Fed step in and say, we want to make sure that the structural damage is behind us, that we're really, the vaccine, the healthcare solution, give it time for that to work, which is why I would say, even with the vaccine, it's the Fed response that's going to be extremely important. Hopefully, Chair Powell's asked this and he can respond that just getting a vaccine is not enough. We need to give it time to make sure it works and the economy is recovering. and then the Fed can take a foot off can take their foot off the gas. So it'll still come down to the Fed, I would argue.